Hi everyone. Just to give an introduction, my name is Shishir Bajpai. I'm working with IIFL Asset Management Company. I have been working here for almost now 11 years with the IIFL Group and almost 26 years in the financial services industry. On the IIFL AMC side, I am part of the strategy and the business development side of the business. So today, what we are looking out here is, since you all know that on the mutual fund side, there are a lot of aspects that we have to look at. So it's not just about the returns that we are talking about, but there are other features also which adds up to it. And today, we would like to talk about expense ratio because that's a pretty important part of the overall fund construct and even how the maybe the return gets defined and part of your selection of portfolio or which schemes that you're going into. So I'll just quickly run through three or four pointers which one can look at it while shortlisting their investments on the mutual fund side. So firstly, what is expense ratios? So these expense ratio is primarily the expense which the fund charges to its investors. Now, there are multiple things which gets part of the overall fund construct. So the expense ratio is one portion of it, and this expense ratio has a lot of inbuilt things within it. So the management fees, the other statutory expenses, the distribution costs which the company has to incur for its business and everything. So this all becomes part of it. So everything comes under one simple head as expense ratio, and that is the maximum to which it can be charged by the AMC for that fund. So there is no other expense. Now these expenses typically vary. So it's not that for every scheme that you'll find the expense ratio is exactly the same. The answer is no, it varies. And fund keep their expense ratio differently based on the kind of strategy that they are looking to build on it. And even it also varies based on how the AUM moves. So maybe I'll just take a quick minute to explain you what exactly it means is. So a lot of these strategies which come probably where it is more related to the index and the other things, there you see the expense ratio being pretty low because you're not trying to, the fund manager or the investment house is not really trying to generate too much of alpha. It's trying to replicate how the market is behaving. So there you'll see the expense ratio being pretty low. There are some of the other strategies where the investor has a particular thought process in mind and he's building his portfolio based on that. There you will see the expense ratio being slightly on the higher side because he's trying to generate much better alpha over the market benchmarks on a longer term basis. Now, whether it plays out, it doesn't plays out is a secondary thing, but at least that's how it gets constructed. Secondly, what the regulation also states that is when you start off, your AUM is definitely small. So with the increase in AUM, your expense ratio also keeps coming down. So by that, what I mean is that if today my new fund comes, my expense ratio is 2.5%, and that's where we start from. So for the first 500 crores, my expense ratio is there. Then once I cross the 500 AUM limit, my expense ratio then drops to 2.25%. So for the next 750 crores, my expense ratio will be 2.25%. So the previous money, the 500, it still gets charged, not that everything reduces to 2.25, it still gets charged at 2.5%. And then it reduces from 12, so 500 plus 750 is 1250 crores. From 1250 to 2000 crores, your expense ratio further comes down. And above that, again, post 2000, again, your expense ratio keeps coming down. So starting from 2.5%, your expense ratio keeps coming down to, say, 1.75%. And that's how it is. So what typically you see on your fact sheets at times, the expense ratios are mentioned. That's the blended expense ratio. It's not what currently it's been there. It's the blended expense ratio which gets mentioned on the fact sheet which all the AMCs publish on their things. So yes, the expense ratio also keeps coming down with the increase in the AUM. So that's one factor. And as I said, the overall expense is based on how the strategy is being designed. Now, the most important point is that should we look at this very closely? The answer is twofold. It's not just that you are chasing the returns and everything. Yes, expense ratio do form a very important part of it, but ultimately you have to see how the fund is trying to generate and what's the consistency of its performance being. So yes, you will consider how the expense ratio is, but that won't be the overriding factor. The main important part is ultimately what the fund and its consistency of performance has been, and if it's still being very consistent and slightly higher on the expense ratio, really doesn't impact the investor on a longer term basis. So that's how I would like to sum up that yes, this is something which is important factor that one should look at, and how the expense ratio plays. And it's not the only guiding factor that one should be looking at when it's looking at investing in any of the funds. So I hope this is useful to everyone to understand how the expense ratio and things get played out. Thanks a lot, everyone.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.